Hello, everyone. I'm Matt with the Fundamental Investing Institute. Welcome to this week's episode of Fundamentals Unfiltered, where we break down the news and focus on the fundamentals. In the news this week, President Trump nominated Stephen Moran, the current head of the Council of Economic Advisors, to fill a vacancy at the Federal Reserve Board. That vacancy is being left by departing Fed Governor Adriana Kugler. Governor Kugler's term is up in January, but she left early for unspecified reasons. Now, the president has stated that Moran will only serve out the remaining term, and this is an interesting development because come January, I think the president is going to put in the person that he believes should be chairman of the Federal Reserve Board, and Jay Powell, the current chairman, he steps down in May, so the few months of next year, the first few months of next year are going to be kind of an interesting shakeup at the Federal Reserve. We'll see what happens, but what I thought I'd do in the next couple of episodes is, people are weighing in on these institutions in very different situations, particularly the Federal Reserve, Bureau of Labor Statistics, and others. These are very opaque institutions, and I think people should have a sense of what these institutions do before kind of jumping into the current political discourse. So what I want to do in today's episode is talk about the Federal Reserve, what it does, and particularly in the context of monetary policy, which is interest rate and credit policy. Now, the Federal Reserve was founded in 1913, but its current structure came about in the mid-1930s with the banking reforms during the Great Depression. And the Fed has three main bodies that guide its decision-making, that guide its operations. Those are the Federal Reserve Board of Governors, the 12 Federal Reserve Banks, and the Federal Open Market Committee. Now, the Federal Reserve Board, it's made up of 7 members. They're all appointed by the President and confirmed by the Senate. Those board members are called governors, and they serve 14-year terms. The terms are staggered so that a term expires in each even-numbered year. So every other year, even numbered, one term will expire. So this allows a president to put in their, who they want to serve, but the Fed is supposed to be an independent institution. It's not completely free of political influence, never has been, but it is supposed to operate monetary policy free of political influence. Now, the governors can only serve one full term, and they can serve a part of a term if a governor steps down. Now, the Federal Reserve Banks, there are 12 of them staggered throughout the United States, and each bank covers a geographical district, and they're responsible for the banks that are in that district. Each reserve bank has its own board of directors. That board of directors elects a bank president, and the Reserve Bank presidents serve for 5-year terms. The third institution, or the third body within the Fed, and this is going to be more important for our purposes, is the Federal Open Market Committee, FOMC, because this is the decision committee for establishing monetary policy, so they make decisions that influence credit conditions. The FOMC consists of 12 voting members, 7 board members, 7 board governor members are on that. So the predominance of that 12-member FOMC comes from these 7 presidential appointees. And in addition to the 7, 5 bank presidents serve it. So there you get the 12. But out of the 5, the head of the New York Fed has a permanent seat on the FOMC, and then the 4 are rotated among the 12 remaining Federal Reserve banks for 1-year terms. And the non-voting bank presidents are still in those meetings, and they're still part of the deliberations, but they do not have a vote. And the FOMC is responsible for its own organization, but by tradition, the chair of the Board of Governors of the Federal Reserve System also serves as the FOMC chair, and the president of the New York Fed serves as the vice chair. Now, the New York Federal Reserve is particularly important because it is involved in the actual operations of setting monetary policy. So it's sort of the, if the chair is kind of the head of this, the New York Fed would be kind of the generals out in the field actually making things happen. So the FOMC holds 8 scheduled meetings throughout the year, and in those meetings, the FOMC votes on policy. So these are the announced meetings that we see that make its way into the headlines and, make its way into the Wall Street Journal, moves markets, etc. So before I want to get into the policy instruments that the Federal Reserve uses, let's talk a little bit about the objectives of monetary policy. The Fed operates under mandates provided to it by the U.S. Congress. Now, those mandates were established initially in 1913 when the Fed was formed. That legislation, of course, brought the Fed into being, but it's been amended a lot over the years. And in 1977, there was an amendment passed that made the current policy goals of the Fed explicit. And there's actually 3 policy goals as laid out in the 77 legislation. One is maximum employment. They have to try to promote maximum employment. The second is price stability, and the third is moderate long-term interest rates. Now, price stability and moderate long-term interest rates are really the same goal. I mean, moderate long-term interest rates come from price stability. So the idea is that the Fed has a dual mandate. You'll hear that term a lot. The dual mandate of maximizing employment and promoting price stability. These two objectives are very often in conflict with one another. So the Fed is constantly in this state of trade-offs between those two policy objectives, and hence the reason why politicians tend to weigh in, because of course they'd rather have looser conditions to promote employment than they would long-term price stability. Politicians have, shorter-term incentives than do central bankers. So the FOMC operates in this domain of monetary policy and has certain tools that it uses. The key policy instrument is the federal funds rate. So when we hear that the Federal Reserve raised or lowered interest rates, we're talking about this federal funds rate. So let's talk a little bit about what federal funds are. So when banks take in deposits from customers, they hold a portion of that as reserves and they lend the rest, right? So there's this great scene in the Christmas movie It's a Wonderful Life where there's a bank run on the institution that Jimmy Stewart's character owns. It's actually a building and loan, but it's a bank-like institution. Everybody comes in wanting their deposits back, as often happened during the 1920s and then into the Depression. And he says, "You've got this place all wrong, as if I have the money in the back. It's in your house, And his point was that, banks lend those deposits out and they only keep a portion of it. So if everybody comes in to demand their deposits at one time, banks can go under, and often did. But the reserves that banks hold come in 2 forms. One is vault cash. So this is the amount of money that is the amount of currency that's literally in the vaults of the commercial banks. And then the second, which is the far bigger portion of their reserves, are reserves held at the Federal Reserve. So in a lot of ways, the Federal Reserve is a bank for banks, right? This is where banks deposit their reserves at these different reserve banks and at the 12 reserve banks that are spread throughout the United States. So it depends on where that bank is in this district, but system-wide, those 12 banks work in unison. And these reserves that they hold are called federal funds. So the federal funds market is where institutions borrow and lend reserves to each other on an overnight basis. And the rate they charge each other is called the federal funds rate. So this is what the Federal Reserve is doing, is it's using policy tools to influence this rate. And the FOMC sets a target range for this rate, and it engages in certain measures to bring that rate within that target range. So let's look at how the Federal Reserve influences the federal funds rate. And this is where the Fed's operating procedures have changed significantly in the last 20 years. So when I was in school a long time ago, we were still in the pre-crisis period. Crisis, talking about the 2008-2009 crisis. And the key policy tool was something called open market operations. The Fed set a reserve requirement. They had a legal reserve requirement that banks would have. And if banks had any excess reserves, those excess reserves that were held at the Fed, they didn't earn interest. So banks did not want to hold excess reserves. So any reserve surpluses or shortages were generally temporary. Some banks would have surpluses, some banks would have shortages. And the banks that had shortages would borrow from the banks that had surpluses. And they would borrow at an overnight rate, and they could make their reserve requirements by borrowing, and they would pay this federal funds rate. So what the Federal Reserve did is it used what's called open market operations, and it would influence the level of reserves. Now, money is a commodity like any other commodity, so its price, i.e. its interest rate, is set by the forces of supply and demand. If demand remains relatively constant, then the key variable is going to be supply, and this is what the Fed did, is it could influence or modify the supply of reserves, and in so doing it could influence the federal funds rate. So when the Fed wanted to lower the federal funds rate, what it did is it bought securities from a group of institutions known as prime dealers. These are institutions that are directed by the Federal Reserve or designated by the Federal Reserve as being those institutions that the New York Fed can transact with, and those prime dealers would hold accounts at the Federal Reserve Bank of New York. So the Federal Reserve Bank of New York has an open market desk, and what they would do is if they wanted to lower the federal funds rate, it would purchase securities from these prime dealers, and it would increase reserve accounts. So it would create these reserves out of thin air, basically. That's how they would pay for the open market purchases. And by increasing the supply of reserves, it would push the price of the federal funds down, or the rate on federal funds down. And conversely, when the Fed wanted to increase the federal funds rate, it would sell securities, and it would decrease the level of reserves from these prime dealers. So it would constantly increase or decrease the level of reserves in the system. And this is the important point. This is how the Fed creates money, quote unquote. And more specifically, it's creating reserves. So it's creating a specific kind of money called base money. And it's called base money because it sits at the base of the economy's money supply. The Fed is the only institution that can do this. That's what makes it so special. So the Fed still uses open market operations as a tool, but it's not the primary tool anymore. It's really just an adjacent supplementary tool to sort of change things at the margin. And the reason is, in the 2008-2009 financial crisis and the subsequent economic weakness that came from it, the Great Recession, if we want to call it that, but there was economic weakness that persisted for quite a few years. The Fed engaged in massive open market operations. It just flooded the banking system with reserves, and it was doing this as an effort to stabilize the financial system and stabilize the economy. And when the system was awash in reserves, open market operations didn't have much effect on the federal funds rate, right? Small changes in supply weren't going to make a difference. So in 2008, the Fed was given a new policy tool by Congress. This policy tool was actually supposed to go, it was already planned before the financial crisis, but it was supposed to go into effect in 2011. Congress pushed it back so that the Fed could use it during the financial crisis. And what this policy tool is that the Fed could now pay interest on reserves that banks held at the Fed. So banks would no longer be disincentivized to operate at a lower level of reserves. And so this is called the Amples Reserves Regime. And the new tool is the IORB, that's interest on reserve balances. So that rate has now become the key policy tool of the Fed. The way it works is that if, since money from the Fed is risk-free, banks can always earn this interest from the Fed risk-free. They're not going to lend at anything below that. So it becomes a floor. So when the Fed wants to increase the federal funds rate, it increases the OIRB rate. And when it wants to decrease the federal funds rate, it decreases it. So this is how it can manipulate interest rates in the federal funds market. Now, not every institution in the federal funds market is a bank. So there are a lot of institutions, particularly like the GSEs, the government-sponsored enterprises, are very active in the federal funds market, but they're not banks. So they cannot earn this IORB rate. So the Fed has a second supplementary tool that they call the Reverse Repurchase Agreement Facility. The way this works is these institutions essentially transact with the Federal Reserve. So what they do is they sell a security to the Federal Reserve or buy a security from the Federal Reserve. So the Federal Reserve has this supplementary measure that they call a Reverse Repurchase Agreement Facility, or RRP facility. The way this works is that the non-bank institution deposits funds overnight at the Fed, and they receive from the Fed a security as collateral. So the Fed is essentially selling these institutions the security, and then it agrees to repurchase the security back the next day at a slightly higher price, that price being the interest rate. So this RRP facility allows the Fed to pay interest to non-bank institutions. The rate works the same as the IORB rate. So those two things in tangent essentially do the same thing, which is to provide a floor upon which the federal funds rate can be priced. Now, other short-term rates in the economy are highly correlated with the federal funds rate, and most notably is the rate on short-term treasury bills. The treasury market is particularly important for the broader credit market for several reasons. First is the U.S. Treasury market is the largest and most liquid credit market or any capital market in the world. So what happens in the Treasury market has broader implications. The second thing is that Treasuries are considered the safest securities available, so the yield on Treasuries acts as a base from which all other interest rates are priced. So it is a base rate for pricing stocks, bonds, real estate, and lots of other things. And every interest rate is really based on a risk premium above Treasuries. So let's look at the 10-year, because this is important. The 10-year is just a loan, of course, to the U.S. government with a 10-year maturity from its original issuance. And it's important because it is the base rate that's used for business loans, residential and commercial mortgages. So it's probably the most important base rate for the mainstream economy. The Fed does not directly influence the 10-year. It can have some indirect influence, but does not directly influence the 10-year. The 10-year is set by market forces. So I want to look at the relationship between the rate on a treasury bill, which of course is directly influenced by the federal funds rate, and the 10-year, which is indirectly influenced by the federal funds rate. And one way we can think about longer term rates, such as the rate on the 10-year, is to think of them as composing two things. One is an average of expected short-term rates, and then the other is what we call a term risk premium. Now, let's say I wanted to invest for 10 years. One way I could do that is to just buy a series of short-term bills. So I can buy a bill that expires in 3 months and then buy another one, and I can do that over that 10-year period. So longer term rates are going to be based in part on what participants in these markets, investors, think will happen with future short-term rates. And then the other component is a term premium. It's a little bit of a catch-all, but it's really the idea that over longer periods of time you have more uncertainty. So you're going to have some risk premium. The other issue is that the short-term treasuries are more liquid. It's a deeper market. So there's this term risk premium that investors pay on for that longer duration. And I can devote an entire episode on the term premium. It's something I'll talk about more in later episodes. But if we assume that term premiums are relatively constant, sometimes this is a big if, but if we assume that it's relatively constant, then the variable that's driving the 10-year is the expected trajectory of short-term rates. So what drives expected short-term rates? Well, this is where inflation expectations come in. And this is kind of the end point of this little lecture. I know we've taken the scenic route here, but it's important. So I've touched on inflation expectations in a recent blog post, and I just wanted to highlight how important it is because I think it's going to be the key variable that anyone who's following this market, whether they're investors and they want to know how this impacts equity prices, or maybe they're direct investors in bond markets, this is really what they need to pay attention to, is inflation expectations, because this is what's going to drive, especially these medium-term rates. So in 2012, the Fed established an inflation target of 2%. So that's how the Fed interprets price stability. It doesn't interpret price stability as zero, although ideally it would. It interprets price stability at 2%. And the reason it wants a modest amount of inflation as opposed to no inflation is that it wants to put an inflation premium into interest rates, because this would allow it to move, this would allow it to cut rates if there's ever a financial crisis or an economic slowdown. So it gives it room to maneuver in the event of a future downturn. And inflation expectations are kind of the real wild card here. And there's two ways that we can think about inflation expectations, or at least measure it. One way is to look, and this is my favorite way, is to look at what's called a Treasury break-even rate. This is the difference between the rate on what are called TIPS, Treasury Inflation Protected Securities. So that is a Treasury security that adjusts for inflation. So its rate is always net of inflation because the adjustment is made to the price. And then we have just a standard Treasury 10-year Treasury rate if we want to use the 10-year, but really you can use any maturity. So the point is to try to match the maturity of the TIPS with the maturity of the unadjusted rate. And if we look at the difference, that is the market's best guess of future inflation. We're recording this in early August, and the break-even rate on the 10-year has been about 2.4%. That fluctuates daily, obviously. Now, another way that we can look at inflation expectations is through surveys. And one of the most popular ones is put out by the New York Fed. It's called the Survey of Consumer Expectations. The most recent survey came out for July 2025, and this showed one-year inflation expectations at 3.1% and five-year inflation expectations at 2.9%. So one of the reasons why interest rates were so low throughout much of the post-crisis period, and that is going into the inflation that came shortly after the global pandemic, is that inflation expectations were very low. Inflation was consistently falling short of the Fed's 2% annual target. So with this uptick in inflation expectations, we of course saw higher interest rates. And this is going to be the key variable moving forward. We want to see how policy would, regardless of where it's coming from, whether it's on the fiscal side from the White House and Congress, or whether it's certain things that the Fed is doing, we want to see the impact that this has on inflation expectations. And this is going to be the two key variables. That's going to be the key variable moving forward in terms of looking at how interest rates are impacted. Of course, I don't have a crystal ball. I don't have an opinion on where interest rates should be. I'm simply saying that this is going to be probably the most important variable moving forward. And in thinking about everything that impacts this variable, that's going to be the real keys to trying to manage credit risk moving forward. So that's where we're going to end in terms of our little primer on the Fed. Again, I just want to highlight that I think it's important to understand what these institutions do, especially for investors. And that's our audience, is retail investors and business owners, and thinking about how these institutions can impact our capital allocation decisions. So thank you everyone for listening. We'll end that here. On subsequent episodes, we are going to talk more about other institutions like the Bureau of Labor Statistics, which has been in the news recently. And we are going to dive more deeply into some of the headlines that impact investors. Thank you for tuning in. Please follow and subscribe so you don't miss future episodes. As always, everyone, focus on the fundamentals. Thank you.